Hello YouTube, my name is Charles Howarth, and today I'm continuing my video series on investing, and I'm going to be specifically talking to you about how you should be investing to try and beat inflation. And what I'm going to do is I'm going to briefly recap what's driving inflation, which is effectively money printing, and then I'm going to talk to you about different places that you can invest your money in a brokerage account to try and beat inflation and preserve, if not increase your wealth. Got open here is a window into a program called TradingView. This is a program that I use to look at all my investments, stocks and shares and cryptos and everything else. So I highly recommend if you want to have a look at investments that you go and check out TradingView. And what I've got up on the screen right now is the US money supply. And I'm going to start there. I did a video previously showing and explaining the impact of increasing money supply on inflation, but I just want to recap very quickly. So this is the increase in money supply in the US. This is the kind of liquid money. This includes cash, short-term deposits in banks, savings accounts. So this is kind of the liquid money supply. And what I'll do is I will do all of the discussion today on the basis of the last 10 years. That makes the maths a bit easier for us to understand kind of returns on investment over that period. So let me resize all this. And so what do we see? Global money supply from 2015 to now, the last 10 years has increased. This is for the United States, has increased by 80%, okay? That's a lot. That means that the number of dollars in the system has increased by 8% on average year on year. What we saw was a massive uptick during COVID where they turned on the money printers, and then there's kind of been a bit of a bounce and it's heading back up. We're expecting Donald Trump to put pressure to increase money printing soon in the US. And what this means is that the value of the currency is devaluing, and this is what causes inflation. This is why the cost of goods and services goes up. This is why when you go to the supermarket, the price of eggs has increased and everything else. And this effect is happening everywhere else. This is Europe, same thing. Europe has increased over the last 10 years, something in the order of 62%. This is the pound sterling. So this is from the UK central bank. So we have a look, something on the order of 50% increase. So money printing's happening everywhere. And so your goal with your investments is that you need to be outpacing this debasement caused by money printing and the inflation associated with it. And what we see is that inflation is causing approximately, rule of thumb, between 3 to 6, 7% increase every year. And what that means is that if you're not increasing your wealth faster than inflation, your purchasing power is going down and you're getting poorer, all right? And the reality is this is actually a stealth tax that the government puts on you. So you need to be doing your investments to be outpacing that. And so the question is, what can you invest in, okay? So step one, you have to have your investment account open. Multiple places you can do this. Sometimes you have them through work schemes where you might get an investment account through work. Actually, sometimes it's handled through pensions. In different countries, they might have different kind of like tax beneficial accounts. The UK has ISAs. In France, they have a thing called a PEA, which you can have a tax benefits. I know in the US, they have other kind of investment trusts, which are kind of tax optimized. So that's the way. Or you could just vanilla go and open an investing account. I strongly recommend Interactive Brokers. I've been using them for the last 8 years. They're my preferred broker. They have accounts in all sorts of different countries. So whether it's euro-based, pound-based, they're in the US. If you can get an Interactive Brokers account, I recommend them. The reason is they have a really wide range of stocks you can buy. They're global. They give great interest rates on the deposit. So when you deposit cash there to do your trading, when you're not, holding stocks, you're holding cash, they actually give you interest on your cash. And they have some of the lowest fees that I found on any platform. And the fees are basically every time you do a trade, they charge you. And so you want those fees as low as possible. Otherwise, it's eating into your profits. So Interactive Brokers, I will put a link in the description below if you want to go and sign up. And I think you can get like $1,000 rebate or something if you use the link. So go and check that out. But Interactive Brokers are excellent. In France, if you want a PA account, I use Bourse Direct. They have I've chosen because they have the lowest fees. so you can see the theme of my choosing. So have a look at broker, find one with the lowest fees, and go and set up your account. So then you've got your account set up and you want to start investing. So what do? Do you just go and buy some stocks randomly? Obviously, the answer is no. So the best thing for you to do is go and have a look at some tracker funds. So trackers, they can have different names, but I've been investing in a thing called an ETF, which is called an exchange traded fund. ETFs are made by companies, and Vanguard is one that I've been using for a long time. And Vanguard is a company where they effectively buy a whole bunch of different stocks. They put it into this fund, and then you can buy the fund. And the exchange traded part means that you can buy and sell these funds. And so if I go down, and I'll actually start off with the world stock market. So let's start off with the global stock market. And this is a Vanguard ETF, the ticker. So if you go to go to Google Finance, or you go here into TradingView, just type in VT or Vanguard Global, and this will pop up. So let's have a look at the global stock market. What this is it's a basket that Vanguard puts together in this fund, this exchange traded fund. It's a basket of global stocks. And let's have a look at what's happened over the last 10 years. So from 2015, so about here roughly, to about here. So 156% increase. So that's a pretty big jump in money. So if you put, let's use a big number. Let's say you put $100,000 in here 10 years ago, you'd have $150,000 now. No, sorry, you'd have much more than that. You'd have 150% increase. So you'd have like $250,000. So that's a big increase. That's about a 15% increase year on year, and a great place for you to go and put your money. What I like about these global trackers is that because they're buying stocks, and to be very clear, the first time I was investing and I had my brokerage account, I bought a global tracker. I actually didn't buy VT. I bought one called the ticker's VWRL. The only difference is it's denominated in pounds, so my money was in pounds because I'm from the UK, and so I wanted a pound tracker, but it was tracking the same stocks, but it was in pounds. So VT, good tracker. There's a benefit of currency in all of this thing you're doing, depending where you live in the world, and depending where you're earning or where you're spending, currency can matter. So just be aware of currencies. And the nice thing with a global stock market tracker is you're not betting on any one country. So this is tracking stocks from China, India, US. Now, I have to say the US stock market is the biggest stock market in the world. So, this is very heavily influenced by the US stock market, but the US stock market is also the best performing market in the world. So, and so very safe place to put it. Upward trends. Let's have a look back in history. So, okay, the fund was only created in 2009, but what you can see is that since the inception of the fund back in 2009 till now, yeah, that's a 500% increase. So, very relatively safe. You can see some volatility, but not too much, and it's kind of up and to the right. So, a good place to invest. Now, the little trick here is that really, this chart of global stocks is really being driven by money printing. So what happens is the governments print money, that works its way into the economy, that goes into the companies, and the stock market goes up. So the reason this is a good place to invest is that it tends to slightly outperform the money printing, because this is effectively all the companies using that money, they generate some profits, and then it works. The downside of this fund is you're not going to make really outsized returns, because you're averaging all the global stocks. So some currencies are like, if the currency in India gets stronger or weaker, that impacts it for that stock part of the stock market. So it's kind of currency de-risked, it's country de-risked. So a de-risk, but kind of should outpace money printing. So a really good place to put your money as kind of a safe bet over the long term. You can see some dips. I mean, there's been some drawdowns here. So if you invested here, you wouldn't want to sold a few months later when it dropped 30%. This was COVID. And then what happened is the governments panicked around the world. They started printing money like crazy. I showed you the money printing spike. That drove the stocks up. We had a bit of a retracement when Russia invaded Ukraine, and now it's heading back up again. So that's a global stock market tracker. Good, safe place to put your money. If you wanted to outperform the global stock market, you could invest in something more specific, and you could go for something like the S&P 500. So the S&P 500 is the US stock market. And so the S&P 500, I don't know why the data stops here, but let's have a look at the S&P 500. So from April 2015 until now, it's gone up just under 200%. So this has done better than the global stock market tracker. The reason is that the US stock market has outperformed the other markets around the world. So again, COVID hit, money printing, Russia-Ukraine war, then rebounding, a very safe place to put your money. To date, American stock market, which is the biggest stock market in the world, has had outsized returns, but a pretty good place to put your money. All right, so we've covered the global stock market. We've covered a specific US stock market. You can also invest in specific stock markets. So you could invest in something like a tracker of the FTSE 100. The FTSE 100 is the top 100 companies in the UK. You could invest on a tracker on the CAC 40. The CAC 40 is the top 40 stocks in France. Typically, the US economy's done better, the US stock market's done better. So if you want a safe place, I'd recommend investing in the S&P 500. The other one that you can do is looking at like the NASDAQ. So the NASDAQ is the tech stocks in the US. So you can have a look. So let's have a look. How's the NASDAQ done? So let me go here. Let me type in NASDAQ. All right, let's have a look at the NASDAQ. So, and what you can see here is there's all sorts of different NASDAQ indexes. Let's just have a look at the NASDAQ composite. So this is not an ETF, but this is just the index itself. Actually, let's do NDX. So let's have a look at this one. How's the NASDAQ done? So the NASDAQ has really performed, again, over this same period. So these are tech stocks, and tech stocks have been doing really, really well, especially since all this AI hype has come in recently. But let's have a look. NASDAQ from 2015 was about here, roughly up to there. 420% increase, so really, really good performance. It's outperformed the S&P 500, and it's outperformed the global world stock market. But the drawdowns and the volatility could be larger. So here, after the Ukraine war, a big 30% drawdown, but these tech stocks have been doing very well. I have personally invested in the NASDAQ. I'll show you how I did it. So I live in Europe, and I have something called a PEA, which is kind of a tax beneficial account. And I wanted to invest in the NASDAQ, but I needed to do it in euros because my spending is in euros and my earnings are in euros. And through this PEA, I was restricted to only buying stocks that are issued in France. And so what I did is I found this. It's an ETF. It's listed in the French stock market by a company called Amundi. So not Vanguard, but Amundi, a different company. Unfortunately, they charge higher fees as a percentage for their funds, but there was a tax benefit here. So this is the Amundi NASDAQ 100 ETF you can see up here. And so I've invested in this one. I didn't invest 10 years ago. I've only been in France a few years, but what you can see is this had a 500% increase in the last 10 years. So ETFs, you can buy them in different currencies. You can buy them in euros or pounds and still invest in the US or the Chinese stock market, whatever you want. So have a look for the ETFs. So NASDAQ's good. That's tech stocks. S&P 500 is good. That's the US stock market or global stock market. So let me just talk to you about a couple of other asset classes. The next one I'll talk to you about is bonds. And the reason I want to talk to you about bonds is that there was over the last, I'd say, 20 years or so, the typical recommendation is for people to have a balanced portfolio of bonds and stock. And that's the typical thing. I was advised, and there was a rule of thumb that I thought was cute, which was you should buy the percentage of bonds in your portfolio should match your age. So if you're 20 years old, you should have 20% bonds and 80% stock. And then when you're 40 years old, you should have 40% bonds and 60% stock. The logic is that the bond market's more stable, drops less in the kind of stock market crashes. And therefore, as you get older and closer to retirement, you want your money in the more stable thing. I don't subscribe to that hypothesis at all, and I'll show you why. So this is a global bonds, sorry, not global bond, this is a US bond market tracker. It's a broad bond market tracker. And what you can see is it's been moving around a bit, but over the last 10 years, it's only increased 20% in 10 years. So that means that if you invested here, actually it's even less than that, sorry, because that was 2012. It's increased 15% in 10 years. That's 1.5% increase per year. That is far underperforming inflation. So bonds, if you'd invested in bonds, the money that you put in here would have been losing purchasing power, meaning you could buy less stuff with your money year on year because the bonds are underperforming inflation. And I don't think that's going to change anytime soon. So I did when I first started investing, I held 20% or 30% actually of my portfolio was in a bond. It was actually a UK government bond tracker in pounds. It went up over like 4 years by 1%. It was completely terrible. So I sold those and I moved into other investments. So bonds is one. I don't recommend it. They've been massively underperforming. What about this? So this is real estate. So this is a Vanguard tracker, an ETF of real estate. My parents made most of their money through investing in stock, but mostly not stock, sorry, in housing. But that's mostly the house they were living in. Houses went up in value tremendously from the 80s onwards. And houses, you can see here, this is an ETF which tracks US real estate, and it's going up and to the right. But there's a lot of volatility in this chart. You can see a lot of up and down. And from 2015 to today, it's only gone up about 76%. So huge volatility, like 100% volatility almost, compared to this the world stock market. In this case, it's a specific real estate market. It's the US. So you're taking a lot of US risk, a lot of volatility, and you're only getting 6-7% return per year. So not amazing returns considering the level of risk. And the issue with this, with housing, is that it's very risky. You can easily get into investing in the wrong place. It's very taxed. It's very taxed and taxable. So yeah, you can make money in real estate, but this is a different game. And if you were to invest from your investment account, the other thing, you can buy something called an REIT, which is a real estate trust. They offer you certain kind of fixed returns, but they've all been underperforming. I would stay away from real estate, at least in an investing account like this. Two more wild cards I'll just throw in there before we close out, and that is gold. So gold is a store of value. The reason is that gold is a chemically inert material, meaning that you can get some gold, you can put it in a safe, and 100 years later, it won't have corroded and dissolved away. Whereas if you held copper or some other metal, it would be all corroded and ruined. So that's why gold has its value, because it's very unreactive and you can store it for long amounts of time. And the gold price is solely linked to that fact that you can store it and it doesn't change. And the reason this is going up is because of money printing, devaluing currency. So actually the gold's not actually kind of going up in value because it's not creating anything productive. Actually, what's happening here is that the currency that's measured in this case in dollars, is devaluing over time. And so over the last 10 years, we go to 2015, we have a look, 144% over 10 years. So that's 14% a year. Not bad. Not as good as the global stock market. Definitely not as good as the S&P 500, and definitely not as good as the NASDAQ 100, okay? So NASDAQ 100 is tech stocks, it's Google, Amazon, you've got NVIDIA and all these things. They're making real productivity, generating real wealth. Gold is gold bars sitting in a safe, just basically tracking the devaluation of currency. And where people get worried about wars and other stuff, they tend to buy more gold. And the problem with gold is it's gone up a lot in the last few months. So this is, in 2024, this is a huge rally. But look, if I go back a bit in time, look at gold from this is from the 80s to 2005. and it was basically completely flat. This is not an exciting asset to invest in. And keep in mind the money printing that was happening at this time. So gold was not a good investment in those times. So gold's interesting. I don't really like it. It's a bit of a pain. You can buy a gold ETF if you wanted to. Could be a way of kind of protecting yourself from doomsday, but I wouldn't put a lot of money into gold. And the last wild card, which I'm a fan of, I'm a bit of a crypto bro, and I believe in it a lot, is Bitcoin. So now this number is going to look very silly, but I'll show it to you just so you've got the comparison. If you were super smart and you got into Bitcoin in 2015, 10 years ago, and you saw that this was the way of the future, you would have made a 63,000% return in 10 years. This is just a phenomenal return. But the reality is that people that bought Bitcoin in 2015 did not hold it until today. When you had these peaks, they would, if they were smart, they'd sell. There's a lot of volatility here. You've seen massive drawdowns. I mean, this drawdown here was like a 70% decrease, a brutal drawdown. If you had a lot of money invested in here and you saw 70% of your value disappearing, so you put $100,000 in and it goes down to $30,000, and that happened to me, you would be very upset here. But if you hold it over a long enough period of time, it's been trending upwards. And the beauty of Bitcoin is that, very much like gold, it's a financial piece of software. It's the strongest, most strongly secured financial network in the world. It's a very good way of storing value. It's a very good way of moving value very quickly and large amounts. And I really believe it's going to be the way of the future. There's a lot of countries looking at investing in Bitcoin now. I think the market cap, so the total market value of Bitcoin, is nearly $2 trillion, if I remember correctly. So this is a major asset now, very volatile. I wouldn't recommend you put more than 5 or 10% of your net worth into it. Some people say 1%. But imagine in 2015, if you'd put 1% of your net worth in it and the rest of your money in a bond index, the Bitcoin 1% would have outperformed your bond investment. So putting a few percent into Bitcoin may not be a bad idea. And as I said, one of the nice things about Bitcoin is that you're not taking currency risk. You're not taking risk on an individual company or a CEO or a president, because it's a completely decentralized global network. There's no one in charge of it. And so you're kind of not taking those type of risks. That's why I like Bitcoin, but very, very volatile. So I hope this content has been interesting. I was going to, in a future video, I might talk about individual stocks, but my message from this video is that if this information was all new to you and you're still unsure about investing, do not invest in individual stocks. In general, buying individual stocks and stock picking, you will underperform this, average of the stock market. So don't do it. That being said, I invest in individual stocks, but I look at them every single day, and I have to use a lot of strategies to protect my returns. And so I don't recommend this unless you're really, really getting into investing and trading. For the first 5 or 6 years of my investing life, I invested in trackers, broad trackers. I made really good returns on them, and I looked at them once a month, maybe, if that, and I didn't touch them. So for those that want a kind of an easier ride, broad trackers, have a look at ETF. Make sure you get the minimum fees you can, both in the broker and on the ETF that you buy. And I hope this was useful. If you have any questions or comment, put them in the comments below and I'll respond to them. In addition, if there's any specific areas that you'd want me to elaborate on more or talk to you about, also put it in the comments. Subscribe. If somebody you know would find this information useful, please share the video with them. And I will look forward to talking to you about investments again in the future.